Hello, and welcome to the National Press Club. I'm Kimberly Adams, a member of the National Press Club's Board of Governors and a host and correspondent of the public radio program Marketplace. We are pleased today to welcome Mary C. Daly, President and CEO of the Federal Reserve Bank of San Francisco. Dr. Daly has been with the Federal Reserve Bank of San Francisco for more than 20 years, serving most recently as head of research before becoming the bank's president in 2018. As president of the San Francisco Fed, Dr. Daly is also a member of the Federal Reserve's rate-setting body, the Federal Open Market Committee. She also hosts the podcast Zip Code Economies, which, as an audio person, I can say is a very compelling look at how where we live affects how we live in this economy. Today, Dr. Daly joins us at a critical time for many Americans. In just a matter of months, the COVID-19 pandemic wiped out an entire decade of economic progress. The effect on our nation's most vulnerable populations has been swift and severe, and has brought to the forefront systemic inequities that have plagued our country for generations. Dr. Daly will talk to us today about the road to economic recovery and why an inclusive plan is essential to America's success in the long term. Viewers of today's live webcast are welcome to submit questions for Dr. Daly throughout the program by using the question submission box below the video player on their screens. I will ask as many questions as time permits. Dr. Daly, the virtual podium is yours.
Thank you so much, Kimberly. That was a very kind introduction, and I much appreciate it. It's an honor to be with everyone on the call today or the video today. As Kimberly said, this is a critical time in our history. Our problems will require everyone's best thinking, and dialogues like the ones hosted here play a crucial role in navigating our way toward a better future. So I'm really delighted to be part of this conversation. Of course, our challenges are many right now. COVID-19 has had a tremendous effect on American life. Just a few weeks ago, we passed a grim marker, 100,000 COVID-related deaths in the US, and still climbing. Oops. Sorry, guys.
Totally fine.
It's okay. There we go. Had a technical glitch. This is what happens on my first Zoom speech. So, as I said, we had a grim marker that we passed. And so to mitigate the spread of the virus, large portions of the country paused all but essential economic activity for more than 2 months when COVID came. And the magnitude of this sacrifice, just to put it in context, is unprecedented in modern history. More than 20 million workers pushed into unemployment, millions more out of the labor force altogether, and countless businesses shuttered, sometimes forever. In both health and economic terms, the costs have fallen most heavily on those least able to bear them. Low-income communities throughout the country, in rural and urban environments, have been disproportionately burdened by COVID-19. Job losses have been concentrated among individuals with less than a high school education, people of color, people with disabilities, immigrants, and many others. And the past 3 weeks have served as a very painful reminder that these are far from the only inequities in our nation. Tensions, unrest, and outrage around instances of police brutality, structural racism, and systemic injustice have flared nationwide, understandably. 3 crises, health, economic, and social, are converging into one difficult moment in American history. And it forces each of us to reflect and consider who we are as individuals and as a collective. It will require all of us, especially those in leadership positions, to take bold action if we're going to chart a course through this turmoil and on to a better future. Now, today, I will focus primarily on our economic challenges and what bold action could look like in that space. While economic equity is only part of the solution, it does provide an essential foundation for making much needed progress on health and social inequities as well. But before I go further, let me give you the standard disclaimer that my remarks today are my own and do not necessarily reflect anyone else in the Federal Reserve System. So let's first talk about the economic challenges we're facing and what they really look like. We began this year in the midst of the longest expansion in our recorded history. While it felt slow at times and it didn't reach every community to the same degree, we nonetheless experienced more than 11 years of consistent growth. And then the coronavirus reached our shores, and a decade of economic progress was erased in a matter of months. In response to the shock, both monetary and fiscal policymakers moved quickly to deliver emergency support to households and businesses disrupted by the virus. At the Federal Reserve, we cut the federal funds rate to essentially zero and used our lender of last resort powers to provide liquidity to volatile financial markets. With the assistance and support of the Treasury, we also provided more direct lending to businesses and to state and local governments. These actions have served to ease market pressures and ensured the smooth flow of funding and credit that is so vital to our economy. Our decisions that we took at that time were firmly rooted in lessons from history. The measures the Fed took during and after the Great Recession, just one decade ago, prepared us to respond even faster and more forcefully to the coronavirus. But lessons from the Great Depression also informed. The mistakes made in the 1930s are still clear in our minds and underscore the importance of rapid and forceful monetary policy response when crises occur. Hindsight and research tells us that that decade after the Great Depression of severe hardship would have been much less acute had monetary policy been more accommodative earlier. In response to the virus, fiscal policymakers also took swift and bold action. Congress and the White House approved several rounds of economic relief, collectively worth almost $3 trillion. The aid was broad-based and included expanding and enhancing unemployment insurance, giving cash payments to most households, and providing direct support to small businesses through a forgivable loan program. Taken together, these monetary and fiscal measures are helping bridge our people and our economy through the immediate hardships caused by COVID-19. And that's the intent, to provide emergency relief so that we can come out of the crisis on the best possible footing and expand more rapidly when the virus is safely controlled or behind us. Of course, at this point, no one really knows if these emergency actions will be sufficient or if more relief will be needed. The virus and how quickly are we able to manage it will determine the length of the bridge we need to build. So we will need to stay flexible and responsive as the situation evolves and prepared to do more if more is needed. Because one of the key lessons from history is that speed of action alone isn't enough. Commitment to action, whatever it takes over the long term, is essential to ensuring a sustainable recovery and a return to robust growth. Now, when you think about it, the hardest lesson from both the Great Depression and the Great Recession is that it took us a decade to dig out. A decade for the economy to fully recover and for the benefits of growth to reach all those displaced by the shock. If I think first about the Great Depression, it began in 1929. And in 1939, 10 years later, overall employment in the US had yet to return to its pre-depression peak, leaving many workers and families still stranded and struggling. Of course, the employment recovery following the Great Recession was faster, but the gains were uneven. In 2018, for example, 8 years after we started doing something about this, incomes for the bottom 20% of households were still below their pre-recession peak. So what do we learn from this? Well, for me, and I think for many, the message is clear. A decade is too long. We can't wait 10 years for economic recovery to reach everyone. And of course, at this point, you might think, or you might even argue, that our ability to reverse the impact of COVID-19 will be limited, that the post-virus economy will be so different that not everyone will be able to adapt, and that we should expect and just learn to be okay with some dislocations remaining. And it's certainly true that many of the recent job losses that have been reported are likely to be permanent. And it's also certainly true that our post-virus economy will look different. But we heard similar arguments during the Great Recession, that we should expect unemployment to remain persistently elevated, well above its prior levels, and that some people may just never recover. The thinking went something like this, that unemployment approaching 10%, such a large shock in the United States, must be in large part due to permanent or structural factors, rather than temporary cyclical disruptions. The subsequent expansion, the one we just came through, proved that these arguments were incorrect. 10 years into sustained growth, unemployment approached 50-year lows, while inflation remained subdued. And we discovered that the labor market was much more flexible than we thought, and that finding maximum employment experientially, empirically, by practicing it, rather than theoretically, yields a higher number than almost anyone thought was possible. And moreover, and I would say more importantly, we found in our conversations with businesses and community leaders, in the data that we can tabulate, that letting the economy run past what we thought was possible has tremendous benefits, especially for those less advantaged in our society. Individuals who had previously been seen as less employable, maybe even unemployable, such as those with less education or experience, and so many of our people of color, were able to get a foothold when economic conditions were sufficiently strong. And those same groups who only lately, at the end of the expansion, got a chance to really experience the benefits of sustained growth, are now among the hardest hit as we respond to COVID-19. But at this point, it's useful to remind ourselves that this is not an unusual phenomenon. It's not new. In most business cycles, in most economic cycles, those least advantaged in the labor market are the very first to be let go when conditions deteriorate. And they're the very last to be hired when conditions improve. So unless we commit to building the foundations for a sustained and robust recovery, we risk losing these individuals, temporarily or persistently, from the labor force and maybe even from the mainstream of economic life. And this, of course, affects the resiliency of our communities and tugs at the things we believe in as a society. This isn't just about fairness, though, although that's clearly important. Less than full employment outcomes risk having many people sit idle, sidelined from work and participation in economic life. And this limits our growth, and it limits our ability to be competitive in the global environment. As policymakers, we have to commit to not letting this happen. Any plan for a long-term economic recovery must include the people that we welcomed into employment during the expansion and that we saw could contribute so vigorously to our economy. This must be the measuring stick we hold ourselves to, that we have an inclusive economy. So with this goal in mind, what should we look to? What's our future path? And the answer isn't simple. It really isn't. And it can't be achieved by one institution alone. At the Federal Reserve, I expect our current stance of highly accommodative monetary policy to continue until the economy has largely recovered what's been lost by the virus or to the virus. Getting back on track to achieving our congressionally mandated goals of maximum employment and price stability is our top priority. And with inflation projected to remain low for some time, we can once again search for the upside potential of our full employment goal. But monetary policy alone can't put us back to where we need to be. We also need fiscal policymakers to commit to sustained investments in our economic future. The need for this was evident before the crisis, and it's even more evident now. Of course, increasing investments may sound like a surprising recommendation. After all, we've already spent trillions of dollars in emergency economic relief. And this has occurred at a time when the federal debt is already at historically high levels. But the key word in our COVID response, both the Federal Reserve's response and our fiscal response, is emergency. These actions were taken to keep households and businesses solvent in the midst of the crisis. Much more will be needed in order to build a strong economic foundation that will allow a full recovery and sustained expansion. Now, let me be clear at this point. I'm not just advocating for increased public spending and debt, no matter the form. The composition of spending is crucial. We need to focus on investments that leverage the talent of everyone and contribute to the economy's long-term growth prospects. We need to remember that inclusive growth is faster growth, and it will pay for itself in the long run. Of course, now is an especially good time to take up this type of investment. Even before the crisis, we were in an environment of low interest rates, low R-star for those who follow that type of thing. And this is expected to continue for the foreseeable future. So this makes public spending relatively inexpensive and easier to finance. And the payoff is potentially large. So let's return to history to think about that. Public works programs during the Great Depression reemployed many of those hardest hit by the downturn and made lasting improvements in our nation's infrastructure, boosting the economy's potential output. The GI Bill following World War II helped educate a generation of young people and set the stage for rapid post-war growth. And the construction of the interstate highway system, which I'm sure we've all enjoyed at some point in our lives, also created jobs and laid the groundwork for our modern economy. So what might today's investments look like? Well, here I see the greatest need is for what I will call opportunity infrastructure, the building blocks that help maximize individuals and help them reach their potential. In those areas, that opportunity infrastructure, I see three types of investment. First, we need to invest in people's health. The coronavirus exposed existing inequities in both health outcomes and access to health care. Structural factors related to race, location, and income have created disparities that leave less advantaged communities more vulnerable to health shocks in the first place. And when those shocks come, access to healthcare can be prohibitively expensive or simply not available. But it's important to remember and to really take in that a healthy economy requires healthy people who can live and work and contribute to our society. So investing in health infrastructure, health access, and health care will improve both individual outcomes, which is important, and help create a more productive labor force, ultimately creating more resilient communities and a more robust society. Next, we need to invest in the full life cycle of education. Education is, simply stated, the best form of insurance against unemployment you can find. And we've seen this time and again, but especially in the recent job losses, which were much less severe for those with a college degree. And educational investments need to begin, we know this from the research, they need to begin with early childhood education so that kids can really get a leg up. But that also allows parents to pursue employment without making difficult trade-offs between their children's learning and their income. Of course, we also need to focus on higher education, making it more accessible and encouraging students to enroll, but also to complete college, letting them know that that's important to them and to our society. And then an often forgotten thing, but something that is increasingly important, is lifelong learning, which means bolstering access to schooling and skills training to help workers displaced by economic shocks like COVID-19. These investments boost employment, labor force participation, and ensure our nation's long-term competitiveness. Finally, we need to invest in digital infrastructure so that we can expand access to opportunity and create more economic resiliency. As shelter in place became the norm around the country in March, being able to get online was a crucial determinant of people's ability to continue engaging in the classroom. Jobs and education are only going to become more reliant on technology in the months and years ahead. And the digital divide means those without adequate connectivity will struggle to be full participants in our future economy. We need to close this gap in order to maximize our economic potential. So let me conclude by saying this. The coronavirus is the largest economic shock most of us have experienced in our lives. It's taken a tremendous toll on all of us. But the inequities it exposed and often magnified have been with us for a long time. Right now, in our country, not everyone gets the same chance to succeed. And it's not for lack of trying, it's for lack of opportunity. Our system, whether we meant it to be or not, is set up that way. But we do not have to accept this. Our nation's economic health, physical health, mental health, and societal health are all intertwined. And while addressing our economic challenges alone can't solve the health and social issues we're facing, it can certainly help. And so today, we find ourselves at an inflection point, a moment when crises converge, and a once in a lifetime or once in a generation opportunity presents itself. The choices we make today will define our future path. We have to choose long-term growth. We have to choose equitable opportunity. We have to choose inclusive success. We can't afford not to. Thank you.
Dr. Daly, thank you so much for those remarks. We'll move to the question and answer session now, and I'll remind those watching online that you can submit questions through the comment box below the viewer. And Dr. Daly, I want to start with the news of the day. Your remarks and a lot of your work have focused on inclusivity and these ties between social issues and economic issues. Today, the Supreme Court ruled that civil rights law protects LGBTQ people from employment discrimination. Can you talk about what this decision means for the economy and perhaps what it means for you personally?
Well, let me start with me personally, since it obviously personally affects me. After it was like a sigh of relief in our household, because while I have a terrific job and I have been able to get there, there are so many more individuals who live in fear and worry that they won't keep their employment. And I have to say, sometimes I even feel that way. And so today was a great day. But what it also did for me is it made me realize that we need to double down on making sure that this decision is not the last decision we make for how to make it an inclusive economy, one where people can really breathe that sigh of relief and focus on what's important in their lives and then in our economy. And so you asked, what does it mean for the economy? Every time we can remove some barrier, some stress that keeps bandwidth of individuals focused on their livelihoods and whether they'll be okay, we free up their potential so that our economy can grow and we can be more productive and we can just be happier and achieve our goals. So this was a great day, in my opinion, a really great day, but not the end.
So there's what is the law of the land, but then there's what happens in practice. How do you imagine this rollout working?
Well, I would say that my experience has been we were changing in this regard before the law. It was I saw it in things I'm doing. It's not just a few companies now, it's many companies making equal employment a practice. So what I really see this doing is telling other employers who might have been less willing, and much more reluctant, or simply didn't want to do it, that they have to do it. And that is something that's important. Even when things are mostly happening in our country and in our world, these signature moves of saying, this is the law of our land, they're critical. And so I see the rollout as continuing as it has been and just continuing to get into the cracks of people who are still not willing to do this. This is going to say that's not okay.
I'll take moderator privilege here and start with a question from one of my marketplace colleagues, Rick Carr. He says, when the Fed first launched the municipal liquidity facility earlier in the pandemic, a number of economists pointed out that its eligibility rules excluded the cities with the highest proportion of Black residents. Neither Detroit nor Wayne County was eligible, for example. 2 weeks ago, the Fed modified the rules, and while these counties are now eligible, a lot of majority Black cities remain ineligible, especially in the Deep South. Can the Fed do more in this case to support the finances of majority Black cities? And can this aspect of the municipal lending facility tell us about the role of race in efforts to emerge from the pandemic recession?
So that's a terrific question. And the facts as you just described them are completely accurate. What the Federal Reserve's been doing is we are focused on how do we get the financing to municipalities and municipalities that would regularly come to the muni market. And when we made the original cutoff and then expanded the cutoff, that's really what this is about. The implicit expectation there, or the implicit idea, is that states could borrow and then redistribute these monies to these smaller cities, making sure that everybody had access to this funding at these, better rates. As we learned that that's not happening as we had suspected or we expected, then we continue to think about the terms that we should offer. So I would say that when you see initial term sheet come out, and then you see the response, that's really the learning that's taking place. And it's going to be important for all localities, all cities, whether they're getting something from the direct lending program of the Fed or whether they're getting it from their states in a form of redistribution or in form of borrowing and giving them a portion of the money. Really, we have to bring everyone along. This pandemic is not the fault of anyone, and certainly any city. And we have to go back and make sure that we're making people whole so that we can continue to expand.
Do you anticipate any additional changes to that program?
We're in the period of looking and taking in more public comment and thinking more carefully about it. So I wouldn't want to front run any of those decisions. And I'm not directly involved in that particular program. We have many programs we're facilitating. So I wouldn't want to say that we're going to make a change anytime soon, but we are actively thinking about this, actively studying it. But let me add one thing. We don't stop. I don't stop. I'll speak for myself just at saying this is the facility we have open. I actually spend a lot of time talking to governors and congressional leaders and mayors and helping broker understanding. So if governors in those states recognize that some municipalities are too small to really get funding at a good rate, they can assist by getting the funding and then providing it to that municipality. So one thing I'd like your listeners to hear is that our actions are not just limited to opening facilities. Our actions are about getting out and talking to banks and localities and businesses about how to broker solutions or more organically than just waiting for the facility.
We have a question from Jeff Frank. He says, in this volatile economic environment, what advice can you offer seniors to ensure that their retirement savings will stretch beyond Social Security allotments?
So one thing that we tell everybody, whether you're a senior or anyone, is that when you're thinking about if you've invested in the stock market or any type of market, staying in for the long run is more important. If markets at this point in time, when news about COVID, we can see this in the daily data, right? When news about COVID is good, the stock market goes up. When news about COVID is a little more uncertain, then the stock market moves down. And so as an investor, this is the advice your financial advisors, which I am not, full disclosure, would give you is stay steady in the boat. It's really not a good time to be moving back and forth on your investments. Have a plan, work with your financial advisor, whoever that is, and stay steady in the boat.
A question for advice for sort of the other end. This is from Gary Heck. He says, Miss Daly's life is truly an inspirational story of overcoming economic and educational adversity to become a successful leader and economic thought leader. Given the impacts of COVID-19 and on the poor and those trying to piece together full-time income, what advice would she have for today's young people in similar circumstances? And maybe if you could briefly describe the history he's referencing.
My history?
Yes, educational.
Okay, sure, of course. I'm happy to do that. So, let me start by saying I spend a lot of my time talking with young people. I feel like that's, my generation, we should do that. And so I spend a lot of my time talking to young people. And the question that they most often ask me is something like this: will my life be permanently different because I'm graduating or coming up in a pandemic and I see all these injustices. And the answer is it's going to be affected, but it doesn't have to be a bad outcome, right? So my upbringing was grew up in Missouri, and we fell through the safety net and the economy when I was young, and I didn't graduate from high school. And I was fortunate enough to meet someone a mentor who helped me think about going to get my GED and then going on to college and then pursuing additional education. And what she really gave me were two things. And this is what I would tell young people, or is what I do tell young people. She gave me a sense that I could be hopeful, that the world today does not define the world tomorrow. And that if I put my mind to it, I can change that path. And so I just wrote a graduation speech, which will be coming out later this week to a high school, and it's called Ambassadors of Hope, because I think that's what she gave me. She made me an ambassador of my own hope, and that's really important if you're a young person. The more practical piece, so that's the advice of inspiration and aspiration. The more practical advice is make a plan, right? Your plans, life throws curveballs all the time, and what people who have been in low income situations their whole lives and have been kind of struggling to manage that, you have resiliency. That's an amazing skill. It's probably the most lasting skill you'll have. And so use your resiliency to say, okay, I can't do what I had planned, but I'm going to do this instead. I tell this to the interns that we have here, because they're now all virtual. They wish they would have been on site, but we're not. So they're going to take this opportunity to learn and to grow and to make a plan that helps them get better. So shorten the window of your goals from not my whole lifetime to just what am I going to do this year, and then just realize every year you're going to make progress.
Marshall Cohen asks, given the importance of the Federal Reserve in the economic recovery, how accurate is President Trump's frequent claim that his policies were the main factor in the pre-pandemic 10-year uptrend in the economy and the strength in the stock market?
So history tells us, if you go back, with a completely objective mind, you look back at decades of history, history always tells us the same thing, that outcomes of an economy are the result of many, many things that go on. They're the result of policies, the result of just the momentum that is in people's confidence, consumer confidence, the global economy's recovering, the individual attributes of our people who work in our economy, that this is all part of an ecosystem and that we all get there together. So as a Federal Reserve policymaker, I would don't ascribe, the success of the last 10 years or even the success of trying to get us through COVID to one institution. I ascribe it to basically every one of us, all Americans. So our policymakers and each of our individuals who work in our economy and continue to move it forward. That's how I think of it.
The president also, though, does tend to blame the Fed when the economy does poorly. Does that argument apply there as well?
I think that argument applies more generally. I've been taught something which I've taken to heart. People will credit you, people will blame you, but what you really want to do is just keep doing your work. And at the Fed, our work is dictated by this. We really hold this. It's our North Star, our true north. We work for the American people, and we have congressionally mandated goals to achieve maximum employment and price stability. And we do those things, and I never think of anything else but that. I think of all those individuals, you mentioned zip code economies, all those individuals in zip code economies and the countless people I serve in our country and across the globe. And that's what I think about when I make policy.
We have a question from Nick Timuraios, forgive me if I mispronounced your name, at the Wall Street Journal. Given the extreme uncertainty facing the current economic outlook, which kind of forward guidance do you think would best help achieve the Fed's dual mandate goals, outcome-based guidance or date-based guidance?
Well, here I will speak only for myself, and I'm more my reading of history suggests that the outcome-based forward guidance has been very effective at getting us towards the goals we have in mind, right? So we have congressionally mandated goals, full employment, maximum employment, and price stability. So having outcome-based goals that are around those two, or outcome-based thresholds that are around those two goals, to me is a very useful way of getting market participants, businesses, and households to understand what the funds rate path will look like, what our accommodative strategy will look like around things that they actually see every day, employment and inflation.
And for those who might be watching who aren't necessarily familiar with these terms, can you give an example of what outcome-based guidance might be compared to date-based guidance?
Sure. Yeah. No, I should have said that earlier. Thanks for the follow up. So outcome based guidance versus date based guidance would go something like this. One way you could do it, and I'll talk about date based first, is you could say we're going to leave the federal funds rate at its current position until some date. You would say back in when we were fighting for the crisis, it was the financial crisis. It was until 2012 or 2013. Outcome based guidance would move away from a date and say we're going to leave the funds rate where it's at until unemployment has at least reached 6% or 7% or 8%, whatever that number is. And it's just a way to get market participants and households and businesses to understand the path of the funds rate going forward, because then they can watch on the news as the information comes out and say, oh, we're still above those thresholds. So the Federal Reserve is not going to be moving interest rates. So it's a way to clearly communicate around a threshold of outcomes as opposed to a threshold of time.
You have talked already in your remarks and also in other forums about the extraordinary measures that the Fed has taken to shore up the economy, and so have your colleagues. Many of the fiscal measures that Congress has passed, like PPP, extra unemployment insurance, and other even local support about not allowing people to be evicted, a lot of these things are expiring just as we might be heading into a second wave. How much more can the Fed do to prop up the economy?
So I'll back up from that question, and just for one moment to say, if we find that we're in a second wave, or we find that the support hasn't been enough, my expectation is that both fiscal agents and the Federal Reserve would move to help lengthen that bridge. I mean, I called it a bridge that you could build over the coronavirus or through the coronavirus. But essentially, we've put forth actions that are meant to build the bridge. If the bridge needs to be longer, then I expect both groups, both institutions, to go back and offer more support. So what we will do is continue to keep our eyes open on what parts. I think of it the way our actions went were this way. We immediately lowered the funds rate. Then we used our lender of last resort powers to help ease market financial pressures. That's really important, because when those pressures ease, then the funds rate cuts we took can help individuals get lower car payments, lower mortgage interest rates. This is how the financial system works. If we need additional support, we would look and see, are there markets that need to be helped along? Are there markets that are still dislocated? Are there additional groups of people that need help? And that's why, we continue to work on this Main Street facility, which just opened for lender registration this morning. But like we have with our other facilities, we get public comment, we see if what we're doing is working, and then we go back in and say, how can we help? It will, of course, be a combination, though, and this is something really important to underscore, of the Federal Reserve and our fiscal agents if we're really going to shore up or build an additional bridge if one is needed. Right now, we can evaluate that.
Gregory Schuckman at the University of Central Florida asks, how important to future economic growth is an increase in the number of U.S. workers holding some kind of post-secondary credential? Does the future of work require an upskilling of America? And if so, how should that be funded?
I have been a student of this very question for a long time. And one easy way to do this is to recognize the following: that educational attainment is not equally available or distributed in our society. So if you're a white American, your chances of being college educated are far greater than if you're a Black American or Hispanic. And that, just equalizing that, would boost our potential output growth in a way that's material. So we do need to upskill our population. And it's not simply that individuals didn't want to, it's that they don't have access or opportunity. if you think even about mid-career workers who get displaced from industries, we're in a period of rapid transition in our economy in the globe, and allowing people to reskill, retool themselves to take the jobs that are emerging, that will also be important. So I mentioned both of those things in my opening remarks, largely because I see those as two enormous opportunities for us, where just simply educating our population more completely would allow us to grow faster. And here, allowing education to be more equitably distributed and opportunities to be more available to everyone would get us much of the way there.
And what about the other part of his question? How should it be funded?
These are the kinds of things that, if we think of our society, we are all going to benefit from having a more educated population, from having a more equal population. And so that's where you really have to think about what role the government plays in this. I mean, one of the things that government does, and it has been constructed to do, is to allow us to make big moves that benefit everyone in our society, so that the rate of return on that can distribute through the society. So I would be someone who would propose that we think carefully about whether this is the kind of investment as a society we would like to make, because society will benefit from it, which would mean government and not private citizens.
Right. I mean, right now the Fed is doing what it can to sort of allow businesses large and small to survive through its lending facilities, as well as city and state governments. Can the Fed do the same thing for individuals that might need reskilling in order to move forward in this economy?
So, Chair Powell has said this before, and I think it's useful to say it again. We have lending powers, we don't have spending powers. So we can lend once society has decided that this is what they want to support. We can't make resource allocation decisions. And this is why we say we're going to open a muni facility, or we're going to support Main Street lending. It's broad buckets. It's not individuals, and it's not even individual projects. So that is strongly something that we have put in the hands of our elected officials, and we as a society must decide if we think these investments are worthwhile. I personally think they're worthwhile, and I think we should absolutely do them. But that's something that we have to really, as a society, debate and discuss, and then take up.
You mentioned earlier that some groups that were the last to recover from the last recession were the first to lose their jobs and maybe the least likely to get them back in the current crisis. Minority groups, people with disabilities, other groups. What specific policies do you think are necessary as we plan our way out of this situation to make sure that those groups aren't left behind?
Well, let me just talk about the Federal Reserve first. And me, not the committee, I'll speak for myself here, is that one thing you can do is what we learned during the Great Recession and the recovery from that, is you can say that this is an important threshold for us, that we want to return to the full employment we just enjoyed, not some higher level of unemployment that we can tolerate. So I think that's a really important piece of the equation. If we say that we are dedicated to getting those individuals back to work, that sends a signal to employers and to businesses that they should invest in those types of things, because that's where we're headed. And I think that's a really important foundation. Then in terms of how to think about the individual workers who might be dislocated, one common thing that people bring up, and I see it here in the 12th district, which is the Western United States, we have a highly tourism-based world. And tourism may not come back for a while. And when it does come back, my anticipation is it'll be different than it was before. So what are we going to do with all of those workers who are in those industries? Well, we might very much have to retrain them and allow them to have access to opportunity. So you go back and you think of the GI Bill, we put that together because we wanted to ensure that all of those people who had served have got an opportunity to become educated and get jobs that are going to be created in the future. Things that are similar to that, where we say we want people to be in the labor market. We want them to have the skills they need to take the opportunities that are before them. I really think that's a commitment that we as a society have to consider.
Dave Airy asked a bit of a follow-up question to what we were talking about in terms of reskilling earlier. Is your suggestion something like an updated GI Bill for post-COVID recovery?
So this is where my Federal Reserve hat is preeminent here. So I wear multiple hats. I'm a member of my community. I definitely serve the community that I represent. I'm an economist by training, studied labor market policy and social policy, and now I'm a Fed official. But one of the things that I've done today is I've put out the big buckets that I think will be important for us to focus on if we are going to pull ourselves out of this and actually make a more inclusive economy. The specific policies that we will take up, those are really part of what I hope this conversation generates today. But our congressional officials and our fiscal agents have to really debate those things. There are plenty of proposals out there for how to do this. But so I don't think we have a lack of ideas. We have a lack of putting it front of center in our debate about whether this is what we want to achieve. So what I'm trying to do today is put this front and center in the debate of what we're trying to achieve and say that there are lots of proposals out there. I don't have a specific one that I would say do this instead of that. I think the time for conversation about those issues is now.
You talked about the post-virus economy. Can you give more detail of what you're seeing in the data thus far that might indicate what that's going to look like?
So, here we're thinking a lot about the future of work because we sit next to all of these high tech firms that have already announced that they're either going to be completely remote work or partially remote work, mostly remote work. And so the workplace will change, right? This will change how we design buildings, how much commercial real estate's demanded, what kind of digital access we need for individuals. It has the opportunity to really be more inclusive because if you're a single mom and live an hour from the businesses downtown and you can work at home, your life just got a little easier if you're a single dad, single parents. Their lives got easier if they can work at home. But it also has these trade-offs where not everybody has that opportunity. So I see our future of work being a broader mix of being in the office, working from home, being more be more resilient if you're in a low contact industry. And that doesn't mean we won't have high contact industries. We certainly will. But I do think in order to make sure that we're resilient, we're going to have to develop these other aspects that just make us more agile when things like this occur. So that's how I see the future of work unfolding, is that it's going to change the footprint of work. And that footprint is going to leave some groups needing more assistance to make that transition.
Even before the pandemic and the associated economic shock, there were alarm bells, domestically and globally, about corporate debt. With interest rates still incredibly low and likely to stay that way for some time, do you have any concerns about corporate debt and how it will factor in to our recovery?
Sure, that was one of the things that we had pointed out as something that I was watching personally, is the highly leveraged corporate sector. And this particular shock is not making those pictures better. Profits are obviously, revenues are going down. The debt that you have to take on in order to survive the pandemic. Some industries are doing great, others not great at all. So I think this is a place to watch. The thing that's going to be really important is to ensure that we can understand the COVID-related response that was needed and provide support. So that comes through lending and through capital markets, et cetera, that the Federal Reserve, and if you're a smaller business, not a corporation, that the CARES Act produced. But these are going to be important things. We have to get our businesses to be healthy and sustainable. And for those that were highly leveraged and don't have revenues, they're probably, and we already have seen a wave of bankruptcies, they probably won't be able to survive in the transition through COVID and into the next place. And so that's going to dislocate a lot of the workforce, and we will have to be ready to absorb them in other capacities. But this is something that we'll continue to watch, absolutely. And I think the lesson might be, although, it's always risky to speculate on what history will tell us, but I think the lesson of all of this might be to corporations is that if you come in too leveraged, your survivability in a shock is less. For those companies that were well positioned, they're likely to survive through this.
But who's bearing the consequences of that? Because you have all of these over-leveraged companies. Who's actually paying the price when, they take on this debt and the interest rates continue to be low? Who is paying the price for that?
Well, traditionally shareholders, right? Shareholders would pay. The worry you might have is it blows or spills back into the banking system, but our banking system went into the crisis very well capitalized, in very good position. And so that was one of the mitigants. If you remember when we talked about highly leveraged corporate sector, it wasn't spilling back into the bank's balance sheets. And so what if shareholders who have taken those bets and made those investments, they might feel some losses. The banks so far are not in a position, but we're watching that carefully where they would feel those losses. I think another loss that we fail to recognize sometimes, and I'll highlight here, is the loss of all those jobs that then we have to find additional jobs for. But that's how business works. It comes and it goes back out. And I think that the big key is here that shareholders might have a different sense of what they're demanding if the highly leveraged corporations they were investing in don't fare as well during the downturn.
We're at the National, well, I'm at the National Press Club. You're probably at your office or at home. But there have been a lot of discussions, particularly on social media, about the lack of diversity in economics and even in business and economics journalism. How do you think that shapes the way that we have talked about this crisis and the economy heading into the crisis and what it means for the recovery moving forward?
Well, there's no doubt. I mean, economics has a diversity crisis. I think this is now widely known and acknowledged. We were outed as a profession, if you will, on that subject, but I think so many of us have been vocal on that. And the way I think of it there, and I this would translate to any place that's not completely diverse, is that you actually have to have people around the table and they have to have voice if we're to spot the problems that are there and spot the solutions that can fix them. And so what you get by just definition, if you have a narrow set of individuals who are analyzing the economy, reporting on the economy, is you get a single lens. You get the lens of the individuals there. And if you don't have diverse lenses, you can't possibly represent the diverse outcomes in the same way. And more worrisome to me is you can't possibly understand the best solutions that we should have to treat all of those problems. So if you think about how it shapes the rest of the recovery, this is why I think some of these issues that are flaring up in our society right now, having these tough conversations, are critically important. It's not only about righting the wrongs that have been created, but it's about setting ourselves in a platform where we can actually recover inclusively so that we can grow. I mean, inclusive growth is faster growth. I think I said that in the speech. I believe this. And the way to do that is by having diverse voices. So doubling down on getting those diverse voices is an imperative, both in the economics profession, but I would say more generally in our society and in those who report on economics.
Denny Gulino of Mace News asks, when will it be appropriate for the Fed to raise its profile for the man in the street or the average citizen for whom understanding and recognition is probably less than for, he says, Smokey the Bear, but I'm guessing what he means is that most Americans probably don't have the same level of knowledge or understanding about what the Fed does as opposed to what how you stop forest fires.
Sure. Well, I think I got a little bit of a pain in my heart when you asked the question, because when you said, when is the time going to be? The time is already here, and we've been trying to do that, but we need to do more of that. So we're committed to doing that. You see this in Chair Powell. He's actually taken a bit of heat in the press for speaking in more layperson language so that more people can be participating in the discussions and the debate. But you also see it in many of the Federal Reserve officials, presidents, governors out in the community. And also when we did Fed Listens as part of our framework review, we actually went out and hosted events in every district to learn about how do people think about us? What do they think about our policies? How do they think about running an economy that's very robust and bringing in these workers versus, generating inflation? So these were our initial. I mean, we've been trying to work on this for a while. Chair Bernanke did the same thing, but we are just getting better and better at it each year. So the answer to your question is, I know we're not Smokey Bear yet, but the time is now. And we're all doubling down on our efforts to do this. Programs like the one I'm on right now are attempts to do this, but importantly, we're also on programs that reach more different people in our population using social media, zip code economies, a variety of other things. This is all a method of trying to help people understand what we do. I I can't stress this enough. Our work serves every American and countless global citizens. That's what we do. And if people don't understand what we're doing, then we've lost some of the value of our public service. And I really want people to think, when they think best in public service, I want them to think of the Federal Reserve System and what we're doing for them. So we have work to do, but we're committed to it.
You today and Chair Powell and many of your colleagues at the Fed have said that the Fed is committed to supporting the economy basically until the economy recovers. If indeed we are in a second wave, if indeed another wave comes in the fall, and we're still waiting on a vaccine or herd immunity or whatever the scientists tell us is going to be still that clamp on the economy due to the coronavirus, what does it mean and what does it look like for our broader economy if the Fed continues some of the measures that you all have been doing for a couple of years?
Well, it's really easy to feel like that would be impossible, right? But I want to take us back to just a decade ago. We took these types of actions. They weren't as large, but they were same type. They were conditioned on the size of the shock. And people were very worried then that we would end up in a place where inflation was spiraling out of control, that we couldn't possibly leave rates low. And then we saw that the benefits to the economy were vast. And we realized that inflation didn't spike up in the way we were concerned about, and that this worked better than many people thought it would. So I would say that we will continue to do what's necessary to move the economy forward, to build a bridge over the coronavirus, and to, when it's appropriate, and now is not the day, but when it's appropriate, start to stimulate the economy and return it back to a place where it can grow and expand for everyone. But right now, we're still in these, we took emergency actions. Now we're waiting to see how what the virus delivers. I mean, Dr. Fauci said this, I've said this, many officials have said this, the virus determines the course of our activity. And Dr. Fauci's talking about it, about when we can come out of shelter in place. I'm moving that on to the economy. The economy really in our recovery is determined by the virus at this point. But the Federal Reserve stands ready to support us while we're in the virus and once we're beyond it.
Last question in the couple of minutes we have left comes from Stephanie McKay, who asks, as the pandemic hit, food banks illustrated how important nonprofits are in providing social safety nets for low to mid-income families. Even if individuals are employed, healthcare, social services, skills training, lifelong learning, affordable housing, food security, and childcare are often provided by nonprofits. Beyond PPP, nonprofits can't realistically rely on lending facilities to remain solvent or to meet increased social need now or in the future, especially with uncertainty about donations and decreases in local taxes that fund these efforts. Can monetary policy be used in any way to help carry nonprofits through the crisis and strengthen their ability to provide services to the most vulnerable?
So, in part of our public listening for the Main Street facility, we're asking those questions. What could be provided for a variety of groups that are not, the businesses, small businesses and medium-sized businesses, that would be not-for-profits and educational institutions, et cetera. But here's something that really becomes clear, not for every nonprofit, but for many, is that alone wouldn't be sufficient. They really need resources, right? Because they're used to getting a flow of resources, and now both of those elements of their resource generation are going down. Donations are going down, and state and local tax revenues are going down. So in addition to what the Fed can do, I would say it's really an important time for all of us, to the extent that we can, to ramp up our donations. It's one of these crises that will not be solved by one institution or by our institutions alone. It's really going to take every American doing what they can to help other Americans who can't do that to get through this. So that's one of the calls that we're making in our communities is, give to the place where you can. And if you can help, give more, because we're going to need the Federal Reserve, the federal government, state and local governments, and importantly, every American to get through this. That's just the crisis we face.
Dr. Mary Daly, President and CEO of the Federal Reserve Bank of San Francisco. Dr. Daly, thank you.
Thank you. It was my complete pleasure.
Normally, when you visit the club, we would give you one of our National Press Club mugs. Since you can't be here in person, we hope you'll visit us at the club in the future when it's safe so we can give you one in person.